Okay, let's dive right into this. Grab your highlighters, pull up those 10 Qs, and put on your most skeptical equity research analyst hat. Today, we are looking straight under the hood of Hubbell Incorporated, ticker symbol HUB. We're going to strip away the media hype, entirely ignore the flashy sound bites, and basically act as investigative journalists for their financial statements. We want to see what is really driving their recent earnings beats. Welcome to The Explainer.
But first, we've got to lay down the ground rules. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
All right, here's our roadmap for today's systematic breakdown. First, we'll do the analyst's reality check. Second, we'll push the stock through our valuation gauntlet. Third, we're uncovering hidden flags in our media blackout section. Fourth, we'll run the Legends reality check. And finally, we'll synthesize the moat and deliver our final verdict. Let's get to it.
Section 1. The Analyst's Reality Check. Looking past the sound bites. So, if you watch traditional financial media, you have absolutely heard the narrative around this company. It's all double-digit growth, Q1 and Q2 revenue beats, and a perfect balance sheet. But look, as data-driven investors, we don't buy the headline, right? We buy the business. And to understand the numbers, you really have to understand the model. Hubbell manufactures critical electrical and utility components. We are talking high-voltage transmission hardware and grounding systems. Their entire catalog is built on this brilliant, undeniable concept: low cost of ownership, high cost of failure. Think about it. If you're building a billion-dollar data center or you're upgrading the national grid, you literally do not skimp on the electrical insulators. You just don't. This essential foundational nature is exactly why they are seeing massive demand right now.
Let's move on to Section 2, the Valuation Gauntlet, where we test the actual fundamentals.
Now, intellectual honesty demands we admit something up front. We lack the proprietary insider data to run all 21 specific theoretical valuation models perfectly. But putting HUBB through a modified gauntlet based strictly on the available quantitative SEC data paints a really stark picture. In Group A's cash flow models, like our DCF and unlevered free cash flow, the implied intrinsic value hovers right around $415. Group B's dividend discount models and residual income point to roughly $390. Group D's asset-based metrics, like net asset value, those trend much lower, yielding about $135 per share. And Group E's real options valuation, which actually credits them for future grid expansion projects, pushes that intrinsic value up to $450. Meanwhile, our Group C basic comparables and multiples tell a story of a completely stretched valuation today. We've got a trailing PE of 31.28, which is incredibly rich for an industrial manufacturer. The PEG ratio is sitting at 2.19, indicating the price is vastly outpacing their actual growth. On the income side, they offer a 1.21% dividend yield with a very safe 32.8% payout ratio. And we're looking at a massive market cap of $24.91 billion. Guys, the models are screaming that this stock is priced for absolute perfection.
Yet, despite those highly stretched multiples, Wall Street isn't blinking. The average consensus analyst price target sits at $564.82. That implies nearly a 20% upside from current levels. So you have to ask yourself, what exactly is Wall Street seeing that the basic multiples are missing?
Well, it comes down to cash. EPS beats can be manipulated all day long with accounting tricks, but free cash flow cannot. Hubbell's management anticipates converting at least 90% of their adjusted net income into free cash flow for the full year. They did $46 million in Q1 and are projecting nearly $968.98 million for the full fiscal year. That kind of real-world cash generation provides a massive, massive cushion for the business.
Which brings us nicely into Section 3, Hidden Flags, the Media Blackout Reality Check.
We are going deep into the footnotes and supply chain realities that traditional financial media completely ignores. Why? Because they don't fit neatly into a 15-second TV soundbite. Let's start with the risks. Red flags. First, the 2.9x leverage ratio. This gets totally ignored because it ruins the perfect balance sheet narrative. It leaves much less room for error with elevated interest rates. Second, grid automation declining 7%. The media focuses heavily on broad utility growth, entirely ignoring this localized weakness in advanced metering infrastructure. Third, they are overvalued on Investing Pro. The strict fair value models fundamentally contradict Wall Street's hyped-up price targets. Fourth, that high PE of 31.28 and PEG of 2.19. These metrics are just too complex for a soundbite that favors momentum trading. Fifth, Q1 electrical margin down 30 basis points. This contraction, due to restructuring investments, was glossed over by the overall company's margin expansion. Sixth, metals and plastics inflation. This gets ignored until it actively crushes the gross margin, though, to be fair, they are currently fighting it with pricing. And seventh, international oil and gas uncertainty. This is easily buried since it represents less than 1% of total sales, but it is a clear headwind nonetheless.
Okay, now let's flip the coin and look at what the market is undervaluing. Green flags. First up, a $20 million Q3 tariff refund. This is an unmodeled, one-time, pure bottom-line boost from overcharged import duties. Pure gravy. Second, their shift to modular solutions. This is a quiet, frankly brilliant bypass to the severe electrician labor shortage we're seeing on worksites. Third, the 765 kV transmission TAM. We're talking about a massive $1.5 billion, decade-long addressable market pipeline that the media is entirely missing. Fourth, a 1.2 book-to-bill ratio. This proves demand and new orders are accelerating much faster than current fulfillment can keep up. Fifth, greater than 90% free cash flow conversion. Cold, hard cash realities that outshine those easily manipulated EPS beats. Sixth, $168 million in share repurchases. Buying back shares below $500 will be stealthily accretive to their earnings by 2027. And finally, a 56-year dividend streak. This is that quiet, boring consistency that hype-driven momentum traders completely overlook.
Moving on to Section 4, the Legends Reality Check. Passing the Greats.
So how does Hubbell actually hold up if we apply the strict historical investing frameworks of the absolute greats? Let's run the numbers for Graham, Lynch, and Buffett. Ben Graham, the absolute father of value investing, requires a PE below 15. Hubbell fails this test immediately, with a trailing PE of 31.28. Furthermore, if we calculate the Graham number using EPS and book value, it yields around $142, falling well short of current prices. What about Peter Lynch? He looks for growth at a reasonable price, utilizing the PEG ratio and applying his fair value formula where PE equals growth plus dividend yield, while Hubbell fails this test as well. A PEG of 2.19 clearly indicates that the stock's price is heavily outpacing its underlying growth. No way around it.
But what about the Oracle of Omaha? Warren Buffett looks for a strong moat and deep quality. And honestly, Buffett would absolutely love the owner's earnings here, marked by that 90% cash conversion and a consistently high return on invested capital that sits well above his 15% threshold. He'd also deeply respect the 56 consecutive years of paying dividends and the incredibly high switching costs of the business. However, Buffett despises debt. Monitoring that net debt to EBITDA via their 2.9x leverage ratio is absolutely required. So for Buffett, it's a bit of a mixed bag. It's a wonderful company for sure, but perhaps not at a wonderful price.
Finally, Section 5, Moat and Final Verdict. Time to synthesize the data.
We've run the gauntlet, we've dug through the footnotes, and we've consulted the legends. Here is exactly how we synthesize this massive pile of data. Valuation verdict. Based on the available multiples, DCF proxies, and the average across our 21 valuation models, Hubbell currently sits squarely in overvalued territory. The market has priced this stock for absolute perfection. As an analyst, you have to separate a great company from a great stock price, and right now, you are paying a massive premium for HUBB's fundamental quality.
Economic moat? But make absolutely no mistake, their Morningstar-style economic moat is actively expanding. According to those 5 sources of an economic moat, Hubbell's is built entirely on extreme reliability and high switching costs for critical infrastructure. Customers are completely unwilling to switch suppliers because the cost of failure is catastrophic. Furthermore, that $1.5 billion total addressable market in 765 kV transmission means this moat is going to get significantly wider and deeper over the next 3 to 10 years. They are digging a very wide trench.
The final takeaway. Look, the strict valuation models are pointing heavily to overvalued. Yet, those hidden green flags, like the massive infrastructure tailwinds, the modular solutions, and that relentless free cash flow, suggest a perfect storm of long-term demand. The data is conflicting, and honestly, that's exactly where the real market is made. So what does this all mean for you? Which side are you on? Are you buying the growth narrative, or are you strictly respecting the valuation? The numbers are all laid out. Do your own homework. We'll see you on the next explainer.